Hello, everybody. This is Frank with Iron Age News. It is Monday, June 22nd, 9:43 a.m. The stock market has been open for long enough for us to check our hypothesis and talk to you now about an important issue with Iran, with the Gulf of Hormuz, with the Strait of Hormuz, and with the United States having been playing the game all along. And we have to ask ourselves, has Wall Street finally called Iran's bluff? And today we're going to look at a fascinating question that goes beyond oil, shipping, and beyond the latest headlines coming out of the Middle East. And the question is simple. What happens when a country says it has closed the Strait of Hormuz and the financial markets don't seem to care? Over the weekend, Iran once again announced that it had closed the Strait of Hormuz. Under normal circumstances, that statement should have sent shockwaves through the global economy. And even though it was done after stock trading, that should have meant that this morning, a Monday at 9 a.m., the trade should have gone boom, right? After all, roughly one-fifth of the world's oil and gas trade traditionally passes through Hormuz. When the conflict first erupted earlier this year, shipping nearly ground to a halt and oil markets reacted violently. Reporters from Reuters mentioned that shipments through the strait had effectively stopped during the initial phase of the war, creating major disruption to energy markets and global trade. Reuters did not tell you what the reason was, and that was then credited to the Iranians when it should have been credited to United Kingdom ship insurance companies, especially. So, what happened today so far? Coming out of the gates charging Monday at 9 a.m., surprisingly little. And you can go check yourself if you don't believe me. And that may be the most important story so far today, what we would have expected. Let's imagine for a moment that the markets fully believed Iran's claims, okay? What would we expect to see? There would have been a surge in the oil prices, not by a dollar or two, not even by $5. Brent crude would likely be moving rapidly towards triple digits as traders scrambled to secure supplies. Airline stocks would come under pressure, transportation companies, everybody involved in the with using oil. Major stock indexes would sell off, shipping rates would explode, war risk premiums would rise sharply if somebody could get them. Investors would run towards safe havens. In short, we would have expected a panic, not necessarily panic among the ordinary people, but panic among the professionals whose job is to price risk. Okay? Because if Hormuz were truly closed for any significant period of time, the economic consequences would be enormous. What's actually happened instead, markets delivered a very different verdict. Oil prices initially moved higher, but then faded. Okay. We did not have the stratospheric jump. Brent crude slipped back below $80 per barrel as investors focused on continuing negotiations and evidence that shipping was still moving through the strait. U.S. stock futures were largely stable. European markets were subdued rather than fearful, but then again, there's also going to be a little bit in there because the Ukrainians bombed a major Russian uh, hydrocarbon situation there, right? So their markets are a little bit different than the rest of ours. Most importantly, we did not see the kind of systemic reaction normally associated with a genuine threat to 20% of global energy flows, which would be the first time. The market heard the announcement. The market simply did not appear to believe the outcome. And that takes us to the shipping test. Even more interesting than the financial markets is what happened on the water. Reuters, again, because they are the voice of Iran anymore for some reason, reported that two crude oil tankers carrying nearly 2 million barrels of oil transited Hormuz on Monday. Two additional tankers entered the Gulf. One of those vessels was headed towards Iraq's Basra loading area. So think about what that means. Leaving tankers are important. That's oil that has already been sold. But tankers arriving are even more important. That represents future business and future confidence or expectations. A tanker returning to the Gulf is effectively making a bet that there will be cargo waiting when it arrives and that it can then leave the Gulf unmolested. That is not behavior one would expect if ship owners believed Hormuz was permanently closed. More especially, would not gamble a super tanker on it, right? Additional reporting shows Qatari liquefied natural gas vessels and other commercial traffic beginning to move again. So the confidence hypothesis would be this. This brings us to a larger idea, and this is an overarching theme that we have put on southfloridaconservative.com in sections. Has nothing more to do with this, but it's a master hypothesis that we then try to take these parts and make it work right. So it brings us to a larger idea, okay? So for months, analysts focused on whether Iran could physically threaten shipping, which I didn't think they could. But perhaps the more important question was also psychological. Could Iran convince markets that shipping was no longer safe? With the help of Western media, what did it do? Could Iran convince insurers that coverage was impossible? That's a question as to who influenced who on that one. We'll never know the real answer. Could Iran convince ship owners to stay away? They did that, right? The ones that were trapped were trapped. The ones that couldn't get in couldn't get in because confidence is ultimately what drives commerce. Today's evidence suggests that confidence may be returning. Not completely. There are still hundreds of ships waiting outside the Gulf for greater certainty before proceeding. Traffic remains below normal levels, but the direction of travel is significant. The market reaction today was not of panic, it was of skepticism. And what this means, if our maritime, meaning the United States, if our maritime assurance hypothesis is correct, today's events may represent the first real world test of this hypothesis that we're working on. The theory was never that the United States could eliminate risk. The theory was that credible military protection, government backed insurance mechanisms, and sustained commercial access could reduce the strategic level of future threats. In simpler terms, the first threat caused a lot of panic. The second threat causes concern. The third threat becomes background noise. If that progression is occurring, then something important has changed because it should get heightened every time, right? Markets are no longer asking, can Iran threaten Hormuz? They are asking, can Iran successfully stop commerce? And those are two very different situations. So where does that leave us? Once again, we have not proven our theory with one day or one trading session because they could slip a missile in somewhere, which they're going to have to really do something if they want to up their terror game. Dropping missiles on the United Arab Emirates or Qatar is not the same thing as taking out a ship in the Gulf. If they were to do that, there are a couple of things that also occur. Environmentally, their coastline becomes useless with all that oil slapping around, right? So today, the markets were given an opportunity to panic. This is what they had the opportunity. 9 a.m., it should have been hardcore and on. Instead, they largely shrugged, right? I think the oil prices is in the 80s. You can look it up, see where it is. Oil prices remain far below the peak crisis seen earlier in the conflict. Shipping is continuing to move. Tankers entered and exited the Gulf. And if you will go on any of the shipping channels and look, they'll be always telling you about their ships that transited on the Iranian side. Those have been proven in most cases, I can't say everyone, but I'll say everyone, to be Chinese ships. And the Iranians are not going to sink a Chinese oil tanker. That would be crazy talk. Everybody else is exiting or entering on the opposite side, the Oman side or whatever it is. All right. So don't think that the Americans aren't slipping around out there looking for bad people because they are. And so anyway, what we're seeing is, like I said, the market is not matching what the situation should be at this point. Investors appear more interested in negotiations than these catastrophes. Perhaps the most significant development was not what Iran said, it was what the world market chose not to do after hearing it. And that should be a big signal to the Iranians that we have seen through them as a global economy. You have been your bluff has been called. We know you're full of shit, and the world is going to continue without us, meaning the Iranians. So they have to get on board with what are they going to do to become relevant again, because we can once again, as I said in other videos, the last thing is, well, we let their oil tankers out, they were full, blah, and they're going to get $20 million or whatever it is per tanker. I don't really care about the amount because it's not enough to make up for all the oil that they've lost. Secondly, on that issue, they need the empty tankers back to take over that um, surplus capacity that they have because everything that they have is full, pretty much. So those tankers, if there are new ones in the return, it doesn't mean the U.S. Navy can't stop in and say no fresh tankers going into Iran tomorrow, which would totally screw them because now where are they going to put the oil, right? But we'll look at that when it comes up. So anyway, this is what I've seen so far. If later on today the oil goes to $128 a barrel, we'll do another video saying we were wrong. But usually, first thing out of the morning in the stock market is when everybody makes their money. All right. So that's all we have for now. Have a good day, and I will talk to you later on.